Every rental property owner you've ever seen retire early, the ones with the paid-off houses and the passive income, and the "I quit my job at 34 story," they didn't get rich from rent checks. That's the part nobody explains properly. Rent checks alone, in most markets today, barely cover the mortgage. Some months they don't even do that. And yet these people are worth millions. So how does a guy who's cash flow negative on paper end up with a seven-figure net worth 15 years later? There's a loop running in the background of every rental property, for separate income streams stacking on top of each other at the same time, compounding into each other, and almost nobody explains it as one connected system. They explain cash flow. They explain appreciation. They explain tax write-offs as three separate topics, like they're unrelated ideas. They're not unrelated. They're one loop, and once you see how it actually connects, you'll understand why rental property has created more millionaires than almost any other asset class in American history, and why so many people who own rentals still don't feel rich, because they're only using one piece of a four-piece machine. By the end of this video, you'll know exactly what the loop is, how each piece feeds the next one, what breaks the loop and wipes people out, and what the actual numbers look like when you run it for real, on a real property, over real years. So what actually is this loop? Here's the simple version before we get into the math. You buy a property with a loan. Your tenant pays rent every month. That rent does four things at once, not one thing. First, it covers your mortgage payment, which includes a small slice of principal paydown, meaning your tenant is quietly buying you equity every single month without you doing anything. Second, whatever's left over after expenses is your cash flow, which you either pocket or reinvest. Third, the property itself is very likely gaining value in the background through appreciation, completely independent of what your tenant is paying, just because real estate tends to rise with inflation and local demand over time. And fourth, the IRS lets you deduct a portion of the building's value every year as depreciation, which lowers your taxable income even though you didn't actually lose any cash. For streams, rent pays your debt down. The market pays your equity up. The tax code lowers your bill. And whatever cash is left over, you get to keep or redeploy. Individually, none of these four things sound like they'd make anyone rich. A few $100s a month in principal paydown. A few percent in annual appreciation. A tax deduction that saves you a few $1,000s a year. But here's what almost nobody explains. These four streams don't just add together. They compound into each other, because the equity you build from paydown and appreciation becomes the down payment for your next property, which starts its own four-stream loop, which builds its own equity, which becomes the down payment for the property after that. That's the loop. It's not passive income in the sense that most people imagine it. It's a self-funding acquisition machine, and once you understand it, you stop asking how much does this property cash flow as the only question, and you start asking how fast is this property refilling my ammunition for the next deal. Let's actually build this loop with real numbers so you can see it move instead of just hearing about it in theory. Take a $220,000 single-family rental in a mid-tier market, something like Indianapolis or Memphis. You put 25% down, that's $55,000 in cash, plus closing costs of around $6,000. So your total entry cost is roughly $61,000. Your loan is $165,000 at 7.25%, which puts your monthly mortgage payment, principal, and interest at about $1,126. You rent the property for $1,750 a month, which is $21,000 a year in gross rent. Now watch how the four streams show up individually. Stream 1, principal paydown. In year 1, roughly $1,400 of your annual mortgage payments goes toward the loan balance itself, not interest. That's $1,400 in equity your tenant just handed you, quietly, without you noticing, spread across 12 rent checks. By year 5, because amortization accelerates, that number climbs to around $2,100 a year. Stream 2, cash flow. After your mortgage, taxes around $2,600, insurance around $1,400, maintenance budgeted at 1% of value, which is $2,200, vacancy at 5% of rent, which is $1,050. You're left with roughly negative $500 for the year. So on a pure cash basis, this property is a slight drag. This is normal, and this is exactly the point where most beginners stop the analysis and walk away thinking the deal is bad. Stream 3. Appreciation. If this market appreciates at a conservative 3.5% annually, which is below the national long-term average, your $220,000 property gains about $7,700 in value in year one alone. Stream 4. Depreciation for tax purposes. The IRS lets you write off the building value, not the land, over 27.5 years. On a $220,000 property, assume $180,000 is the building. That's $6,545 a year in paper losses you can use to offset rental income, which, depending on your income bracket and whether you qualify as a real estate professional or fall under passive activity rules, can save you anywhere from $1,000 to $2,300 a year in actual tax liability. Now add it all up honestly. Negative $500 in cash flow, plus $1,400 in principal paydown, plus $7,700 in appreciation, plus roughly $1,500 in tax savings. Your true annual return on this cash flow negative property is approximately $10,100. On a $61,000 initial investment, that's a 16.5% total return in year one, on a property that a beginner would have rejected the moment they saw the negative cash flow number. This is the entire trick of the loop. Cash flow is the smallest, slowest moving piece of the machine, but it's the only piece most people look at. Now here's the part that actually turns this into wealth instead of just a nice spreadsheet. What happens to that equity? By year 5, between principal paydown and appreciation, this single property has built somewhere around $65,000 to $75,000 in equity above what you put in. That equity is sitting inside the property, doing nothing unless you pull it out. This is where serious operators use a cash-out refinance or a HELOC, a home equity line of credit, to extract a portion of that equity, usually up to 70 to 75% loan-to-value, and use it as the down payment on property number 2. Now you own 2 properties. Each one is running its own 4-stream loop simultaneously. Property 1 is still paying down its own debt, still appreciating, still throwing off a small tax benefit. Property 2 just started its own version of the same cycle. In another 5 years, you refinance again, pull equity from both properties, and buy properties 3 and 4. This is not a metaphor. This is literally how portfolios scale from 1 door to 20 doors without the investor needing to save up a new down payment from their day job every single time. The properties fund their own expansion. That's the loop closing on itself. Most people who own one rental property never do this. They let the equity sit there, untouched, for 20 years, and they wonder why their net worth barely moved compared to the guy down the street who's got 12 houses. The difference usually isn't that he found better deals. The difference is he pulled the equity back out and put it back to work every 4 to 6 years instead of letting it sit idle. So if the loop is this powerful, why does it break for so many people? What are the hidden costs that stop the machine from turning? The first one is over-leveraging the refinance. When you pull equity out to buy the next property, you're increasing the debt load on the original property, which increases its monthly payment, which shrinks or eliminates its cash flow. If you refinance too aggressively, too many times, in too short a window, you end up with a portfolio where every single property is cash flow negative simultaneously, and you're covering the shortfall out of pocket every month, betting entirely on future appreciation to bail you out. That's not investing anymore. That's speculation with extra steps. The second hidden cost is vacancy stacking. On paper, a 5% vacancy allowance sounds fine when you own one property. But vacancies aren't evenly distributed across a calendar year. They cluster. If you own 8 properties and 3 tenants happen to move out in the same quarter, which happens more often than people expect because lease renewal cycles tend to sync up over time, you can be covering 3 empty mortgages simultaneously while your reserve account, which was sized for 1 vacancy at a time, gets wiped out in 6 weeks. The third hidden cost is deferred maintenance compounding. A 1% of value maintenance budget works fine in year 1 when everything in the house is relatively new. By year 8 or 10, the roof is aging, the water heater is aging, the HVAC system is aging, and they often start failing in the same general window because they were often installed around the same time. A property that costs $2,200 a year to maintain in year 1 can suddenly need $14,000 in a single year around year 9 or 10. If you haven't been reserving for this specifically, separate from routine maintenance, this bill comes as a genuine shock, and it can force a bad refinance or a forced sale at the worst possible time. The fourth hidden cost, and this is the one that catches even experienced investors, is interest rate resets on commercial and portfolio loans. Once you have 5 or more units under a single lender relationship, many banks push you into commercial-style terms, which often means 5 or 7-year balloon payments or rate resets rather than a locked 30-year rate. If your rate resets from 5% to 8% in year 6, your monthly payment across a large portfolio can jump by thousands of dollars overnight. And if your cash flow was already thin, this single event can turn a healthy loop into a collapsing one within a matter of months. Let's look at how real people have actually run this loop at different scales, because the mechanics are the same whether you're doing it with one house or 300 units. Grant Cardone is probably the most visible example of running the loop at the top end. He didn't start there. He bought a single residential property in Houston in the late 1980s, lost money on it initially, and it took him years to actually understand what he was doing wrong, which was buying based on appreciation hope rather than cash-flowing fundamentals. Once he shifted into multifamily apartment complexes, he started applying the loop at scale, refinancing stabilized properties to fund acquisitions of new ones, syndicating capital from outside investors to accelerate the cycle faster than his own capital alone could support. By 2023, Cardone Capital controlled more than 12,000 units with a portfolio value exceeding $4 billion, and the entire structure is the loop, just running through a fund vehicle instead of a personal mortgage. On the completely opposite end of the spectrum, Brandon Turner, who spent years as the face of the Bigger Pockets podcast, ran the loop starting with almost nothing. He bought a duplex in Washington state in his mid-20s using an owner-occupied loan, meaning he lived in one unit while renting the other, which qualified him for a lower down payment and a better interest rate than a pure investment loan would have allowed. That property built equity over a few years through paydown and appreciation, and he pulled that equity to buy a 4-unit building, then used the combined equity from both to move into a 24-unit complex, all before turning 30. He didn't do this by saving up new cash each time from a day job. He did it by refinancing existing equity forward into the next deal, over and over, which is the loop in its purest form. And then there's a slightly different version of the loop, the short-term rental accelerant. Rob Abasolo built a portfolio of unconventional properties, things like converted barns and unique cabins, that he rented on platforms like Airbnb instead of as long-term leases. The same 4-stream loop applies underneath: principal paydown, appreciation, depreciation, but the cash flow stream gets dramatically amplified because a property that might rent for $1,800 a month long-term can generate $4,000 to $5,500 a month as a well-run short-term rental in the right location. That extra cash flow means the equity in his properties often builds even faster because the excess income itself gets stacked as savings that fund the next down payment even without waiting for a formal refinance. Across all 3 of these examples, at wildly different scales, the underlying engine is identical. Equity gets built, equity gets extracted, equity gets redeployed into the next asset, and the cycle repeats. Now let's talk about how the loop actively destroys people instead of building them, because this is the story nobody puts in the highlight reel. The most common failure pattern isn't a single bad decision. It's the loop running in reverse. Here's how it happens. An investor buys their first property during a hot market, when prices are elevated and cash flow is already thin from day one. They see some initial appreciation, get excited, and refinance early. Maybe within 18 months, to pull cash out for property number 2 before the equity has really had time to build a cushion. Now they own 2 properties, both with fairly thin equity margins, both close to cash flow neutral. Then the market softens slightly, or rates rise, and property values flatten or dip. Suddenly there's no equity to pull for property number 3, but they've already committed to expenses on 2 properties, sometimes stretching for a third, using a higher interest bridge loan or a personal line of credit because they're convinced the appreciation will catch up. Then a tenant stops paying on one unit. A major repair hits on another. The investor starts covering the shortfall from personal savings, then from credit cards. And because the properties are cross-collateralized or under personal guarantees, missing a payment on one property starts threatening their standing on all of them. This exact pattern is what wiped out an enormous number of investors in 2008, and it happened again, at a smaller scale, in 2023 and 2024, when rates rose from historic lows to multi-decade highs faster than almost any forecaster predicted. The loop that builds wealth when it's running forward, equity feeding equity, is the exact same loop that destroys wealth when it's forced to run backward, debt feeding debt. The single biggest differentiator between investors who survived both crashes and investors who lost everything wasn't how many properties they owned. It was whether they kept enough cash reserves to survive a bad 6 months without needing to pull equity or borrow against future appreciation that hadn't happened yet. The rule serious operators live by: never extract equity you'd need back within 12 months, and never let a refinance push a property's cash flow below zero without at least 6 months of that property's total expenses sitting untouched in reserve. All right, let's actually run the loop forward across real years with 2 full scenarios, because the theory only matters if the math holds up. Scenario 1, the patient single property investor. You buy that $220,000 property from earlier with $61,000 down. You don't refinance. You don't scale. You just hold it for 15 years and let all 4 streams run on autopilot. Year 1 total return, as we calculated, is around $10,100 across all 4 streams. As rents rise with inflation, roughly 3% a year, and your mortgage payment stays fixed because it's a 30-year fixed loan, your cash flow stream slowly improves, moving from negative $500 in year 1 to roughly positive $2,800 a year by year 10 as the gap between rising rent and flat debt service widens. Principal paydown accelerates every year as amortization shifts more of each payment toward the loan balance, climbing from $1,400 in year 1 to around $2,900 by year 15. Appreciation, compounding at 3.5% annually on a rising base value, adds $7,700 in year 1, but climbs to over $13,000 by year 15 as the property's value itself grows. By year 15, this single $220,000 property is worth approximately $368,000. Your remaining loan balance, after 15 years of paydown, is down to roughly $128,000. Your equity position is $240,000 on an original cash investment of $61,000. That's a 3.9x return over 15 years from one single, unremarkable property that a lot of beginners would have rejected in year 1 because of the negative cash flow number. Scenario 2, the operator who actually runs the loop. Same starting property, same $61,000 in, but this time, in year 5, once the property has built roughly $70,000 in equity, you do a cash-out refinance, pulling out $45,000 while keeping a healthy equity cushion in the original property, and using that $45,000 as the down payment on a second property. This one a $240,000 duplex, generating $2,400 a month in combined rent. Property 2 starts its own 4-stream loop from year 5 onward. By year 10, Property 2 has built roughly $55,000 in its own equity, and you refinance again, pulling out $35,000 to buy Property 3, a $200,000 single-family home. By year 15, you're not holding one property, you're holding 3, worth a combined $890,000, with combined outstanding debt of roughly $410,000, giving you total equity of approximately $480,000 on that same original $61,000 cash investment, plus the modest personal cash flow you kept redeploying along the way. That's roughly a 7.9x return over the same 15-year window, more than double the outcome of the patient single-property investor, using the exact same starting capital, the exact same market conditions, the exact same interest rate environment. The only difference between Scenario 1 and Scenario 2 is that one investor let the equity sit idle inside a single property, and the other one recognized the loop and kept feeding it forward. It's worth zooming out and looking at how this loop has behaved across different economic periods, because the mechanics don't change, but the speed absolutely does. From 2010 through 2019, coming out of the housing crash, interest rates sat near historic lows, often below 4% for investment property loans, while home values in Sunbelt cities like Phoenix, Austin, and Charlotte climbed 60 to 100% over the decade. An investor who bought and refinanced aggressively during that window could run the loop at an almost unfair speed, because the appreciation stream alone was doing more work than most entire portfolios do today across all four streams combined. That era created a huge number of new landlords who assumed the loop would always spin that fast, and many of them never learned to respect the cash flow and reserve discipline that actually protects the loop when conditions change. Then 2022 arrived, and the Federal Reserve raised rates from near zero to over 5% in under 18 months, the fastest tightening cycle in 4 decades. Investment property mortgage rates jumped from the 3 to 4% range to 7 to 8%. Anyone who had structured their portfolio assuming rates would stay low forever, anyone who had over-leveraged the loop expecting to refinance again soon on favorable terms, got caught with properties that suddenly couldn't cash flow at the new rates and couldn't easily refinance out of trouble either, because higher rates also meant tighter lending standards. The investors who came through that period intact were, without exception, the ones who had kept real cash reserves and hadn't stretched the loop past what their actual rental income could support on its own, independent of appreciation assumptions. The lesson from both cycles is the same lesson, just proven twice a decade apart. The loop is real, it compounds, and it has created enormous, legitimate wealth for people who understood how to run it. But it only compounds forward when it's fed responsibly. The moment you force it to run on hope instead of arithmetic, it turns into the exact same mechanism that bankrupts people, just running in the opposite direction. So here's the real answer to what actually makes rental property owners rich. It was never really about the rent check. The rent check is the smallest, slowest piece of a 4-part engine that most owners never fully activate. It's the quiet principal paydown you don't see happening every month. It's the appreciation sitting in the background, invisible until you check the number years later. It's the tax code quietly lowering your bill on income you never even had to work an extra hour for. And it's what you choose to do with the equity all 3 of those streams build up over time, whether you let it sit there comfortably or whether you pull it back out and put it to work again. The investors who look ordinary on paper, cash flow negative, no dramatic story, nothing flashy, are very often sitting on the largest long-term returns, simply because they understood they were running a loop, not collecting a paycheck. And the investors who chase the biggest, flashiest cash flow numbers while ignoring reserves and over-leveraging every refinance are very often the same ones who end up as the cautionary story in someone else's video 5 years later. The loop doesn't care which one you are. It just keeps running, forward or backward, based on how carefully you feed it.